Hello, and welcome to Forex Academy. Thank you for joining me today. We shall be discussing a very important topic today. But before we dive into the heart of this course, I have a quick but very important message. The content we're about to explore is for educational and informational purposes only. Trading financial markets involves a substantial risk of loss and is not suitable for every investor. Past performance does not guarantee future results. You should carefully consider your financial situation and risk tolerance before making any trading decisions. I am not a financial advisor, and the information presented here is not financial advice. Now, with that out of the way, let's talk about why we're here. The title of today's course is Why Most Traders Fail in 2026, Avoiding the 3 Deadly Discipline Traps. The numbers are stark. A staggering 87% of retail traders fail to achieve profitability within their first 18 months. This isn't about bad luck or a lack of intelligence. It's about a fundamental mismatch between the modern market structure and the trader's psychological wiring. Over the next hour, we will dissect this problem using 2026 data, and I will give you a clear, actionable framework to beat the odds. By the end of this session, you'll understand exactly why discipline, not a fancy indicator, is the only sustainable edge you have left. Before we go any further, if you find this content valuable, please hit that like button, share this with a fellow trader who needs to hear it, and subscribe to the channel with notifications on so you never miss a lesson. Let's get started. Here's our roadmap for today. We're going to start by defining the 2026 market landscape. It's a battlefield unlike any we've seen before. Then, we'll dismantle the first deadly trap, the illusion of algorithmic certainty. After that, we'll tackle the second trap, which is how automated volatility feeds into impulsive over-leveraging. This leads us to the third and final trap, the 3 core cognitive biases that destroy more accounts than any market crash ever could. Finally, we'll conclude with a survival protocol, a practical, step-by-step system to transition you from a chart-obsessed novice into a disciplined, professional risk manager. Let's set the stage. Why is 2026 different? Why are we focusing on this year? Because 3 structural realities have converged to create a perfect storm for the undisciplined trader. First, the rise of algorithmic determinism. As of last year, a JP Morgan analysis confirmed that over 3/4 of all trading volume is now driven by algorithms. Your counterparty is no longer another retail trader like yourself. You are trading against AI-driven liquidity providers that can detect and react to your order flow in milliseconds. Retail flow accounts for only about 12 to 15% of the total. This means the market is faster, smarter, and more ruthless than ever. Second, the explosion of 0 DTE, or 0 days to expiry options. These instruments now account for a majority of all S&P 500 option volume. This creates a phenomenon called gamma exposure. When retail traders over-leverage with these products, it forces the market makers to hedge their positions aggressively, turning what should be a minor price movement into a violent, liquidity-driven spike or crash. You are no longer just trading the market. You are trading the dealer's hedging models. And third, the gamification of leverage. Fintech apps have made it effortless to trade with high leverage. The average account size on these platforms is just $3,500. But the average leverage used is 4 to 1. This creates a dangerous illusion, the idea that with small capital, you can achieve life-changing returns. It's a cognitive disconnect that separates the action of trading from the very real financial consequences. This is the battlefield we are stepping onto. This brings us to our first deadly trap, the illusion of algorithmic certainty. This is the belief that because you have access to advanced tools, you have control. This is a dangerous fallacy. It starts with the black box fallacy. This is when traders subscribe to AI bots or signal groups promising 80% win rates. It triggers a cognitive bias called automation bias, where we defer our critical thinking to a machine. A 2025 study by UC Berkeley found that users of these black box systems actually underperformed manual traders by 22% annually. Why? Because they didn't understand the system's risk parameters. They would override the algorithm during a losing streak. making the very emotional decisions the algorithm was built to avoid. They stopped paying attention to the broader market context, like a Federal Reserve announcement, that made the algorithm irrelevant. Then there's the myth of the perfect entry. An algorithm cannot predict the future. It can only calculate probabilities based on the past. The real danger is the crowded trade. When thousands of retail traders all get the same buy signal from a popular indicator or bot, they all enter at once. And what do you think the smart money, the institutional algorithms do? They see this cluster of liquidity and reverse the move, triggering the stop losses of the crowd in a cascade. We saw a perfect example of this on February 12th of this year, when a $1.2 billion long liquidation occurred in the E-mini S&P 500 futures in just 7 minutes, following a widely flagged retail algo buy signal. So how do we dismantle this illusion? We change our relationship with the tool. Stop using algorithms to decide what to trade. Use algorithms only for execution. Use bracket orders and OCO. One cancels other. Orders to enforce your plan. The trader must remain the strategist. The algorithm is simply your clerk, there to execute your strategy with mechanical precision. Now let's move to the second deadly trap, which is how the market's automated volatility triggers our own impulsive behavior, specifically our tendency to overleverage. There are 3 key volatility triggers built into the market's DNA right now. First, gamma hedging from those zero DTE options we discussed. Second, the daily rebalancing of leveraged ETFs, which creates predictable but violent intraday swings at the market close. And third, institutional stop-hunting algorithms designed to probe beyond obvious support and resistance levels to trigger retail stop clusters before reversing. When these triggers cause a sudden spike, it creates a powerful emotional response. The data shows that traders using one-click leverage platforms have a 340% higher trade frequency. Why? Because it triggers a dopamine feedback loop. High leverage amplifies the neurochemical response, creating a form of behavioral addiction. The trap is this formula. You see a sharp move, you view it as an opportunity, and you impulsively increase your position size. But let's look at the mathematics. If you use 10-to-1 leverage, a mere 5% adverse move wipes out 50% of your capital. If you double down on a losing position with that same leverage, a 7% adverse move triggers a margin call. This isn't a theory. Brokerage data shows that over 2/3 of margin calls happen not during major crashes, but during routine intraday volatility spikes of just 1 to 2%, where traders were simply overleveraged. The survival technique is what I call pre-committed risk allocation. Before the market opens, you must define your maximum daily loss. I recommend 2% of total capital. Once hit, you are done for the day. Your position sizing should be inversely correlated to volatility. Use the average true range indicator. If volatility is high, your leverage must be low, and use your platform's built-in safeguards. Set your daily loss limit in the software so it automatically locks you out. This removes the impulse to hold and hope. This brings us to our third and final trap, the cognitive biases that live inside our own minds. Success in 2026 is defined by your ability to neutralize these 3 specific biases. The first is gambler's ruin, or the overestimation of win rate. We become obsessed with being right. Prop firm challenges have amplified this, encouraging traders to cut winners short to hit a target and hold losers to avoid a drawdown. But an 80% win rate is meaningless if you're risking $5 to make one. That's a negative expectancy. The fix is simple. Enforce a minimum 1-to-2 risk-to-reward ratio on every trade. Your potential profit must be at least double your potential loss. The second bias is revenge trading, driven by the sunk cost fallacy. After a stop-loss triggers, your brain releases cortisol, impairing your judgment. You enter a state of pathological gambling and double your size to get even. We saw this in a real case in 2025. A trader with a $50,000 account lost $2,000 on a bad zero DTE trade, then doubled down. Within 90 minutes, the account was down $18,000, triggering liquidation. The fix is a 30-minute cooling off rule. Any loss exceeding 1.5% of your capital mandates a complete disconnection from the platform. Walk away. Reset. The third bias is overconfidence or illusory pattern recognition. You stare at a 1-minute chart, overlay 12 indicators, and see a pattern that isn't there. The European Journal of Finance confirmed that over 84% of patterns identified on sub-5-minute charts are statistically indistinguishable from random noise. Novices take 20 to 30 trades a day, while a rational model suggests only 1 to 3 high-probability setups exist. The fix is to shift to higher time frames, 1 hour, 4 hour, daily, where patterns have statistical significance, and adopt the 80-20 rule. Spend 80% of your time on preparation and journaling and only 20% on execution. So, we've identified the traps. Now, let's build the fortress. This is the survival protocol, and it starts with what I call the trader's constitution, a written, immutable set of rules that governs all your trading activity. Without this, discipline is just an emotion, not a process. Let's look at a sample constitution. You have a rule for capital preservation, a maximum daily loss of 2%, with the consequence being a 24-hour trading ban. A rule for position sizing, max risk per trade of 1%. A rule for a leverage cap, which you should lower during high-impact news events like FOMC. A rule for trade frequency. I suggest a max of 3 trades per day. And even a rule for your emotional state. If you've slept less than 6 hours or are under personal distress, you do not trade. The point is, these rules are non-negotiable. They're your guardrails. And here's the proof that this works. The Trading Psychology Institute found that traders who maintain a detailed, quantitative trade journal improve their net profitability by an average of 32% within 90 days. So, let's look at what that journal should contain. Your trade journal is your most powerful metacognitive tool. It's not just a record of wins and losses. It's a mirror that forces you to confront your own behavior. For every trade, you need to log 4 things. First, a screenshot of the chart with your entry and exit clearly marked. This captures your technical reasoning. Second, a pre-trade checklist. Did you follow your constitution? Was a risk-to-reward ratio at least 1 to 2? Third, your emotional state at the time of entry. Were you calm, anxious, overconfident, or feeling revengeful? This is crucial for pattern recognition. And fourth, the hard metrics. Win or loss, the actual risk-to-reward versus the expected one, and the actual versus expected price movement. Then, you do a weekly review. You look for patterns. Are your losses happening on Mondays? After 2 consecutive wins? During high-impact news? This review is where you turn data into self-awareness. Finally, the last piece of the survival protocol is understanding the survival math, the risk of ruin formula. This is the probability that you will lose a specific percentage of your account, given your win rate and risk parameters. I won't make you do the calculus here, but the concept is simple, and it's the most important takeaway of this entire course. If you risk 2% of your account per trade, you need 50 consecutive losing trades to blow out. That's a lot of bad luck. But if you risk 10% per trade, you need only 10 consecutive losing trades to blow out. Now, let's overlay this with the 2026 reality. Because of automated volatility, gamma squeezes, and flash crashes, the market can produce 5 to 10 consecutive losing trades within a single hour. This means that if you're risking 10% per trade, you are mathematically guaranteeing your own ruin in the current environment. You are not a trader. You are a gambler waiting for a routine volatility spike to end your account. Surviving and thriving means accepting the boring, unsexy reality of risking 1 to 2% per trade. It means playing the long game. So, we've come full circle. We started by identifying the traps, and we've built a protocol to avoid them. The question now is, what is your edge? In the algorithmic, hyper-leveraged, high-speed landscape of 2026, the retail trader has no edge in speed, no edge in information, and no edge in computational power. The only sustainable edge that remains is behavioral discipline. It's the one thing the algorithms can't replicate. The final verdict is this. Most traders fail in 2026 not because they cannot read a chart, but because they refuse to acknowledge that trading is not a game of being right. It is a game of risk management. The illusion of algorithmic certainty makes you complacent. Automated volatility triggers impulsive overleveraging, and your own cognitive biases ensure you repeat the mistakes. The novice seeks the perfect entry, but the disciplined risk manager engineers the perfect exit strategy and enforces it with mechanical rigidity. Your survival begins now, not with a chart, but with a plan. Before we wrap up, I want to give you full transparency on the data that powers this course. The conclusions we've drawn aren't just my opinion. They're backed by rigorous research. You can find the full details in the slides, but I encourage you to look up these sources. From the CBOE Global Markets for the Zero DTE data, to JP Morgan for the algorithmic trading insights, to FINRA for the regulatory perspective, and to the academic studies from UC Berkeley, the Journal of Behavioral Finance, and the European Journal of Finance. All of this is publicly available, and it all points to the same conclusion. Discipline is the only edge. In conclusion, I want to leave you with a thought from one of the greatest investors of all time, Benjamin Graham. He said, "The investor's chief problem, and even his worst enemy, is likely to be himself. The market is a powerful opponent, but the only person who can truly take your capital is you by failing to control your own impulses." You now have the framework to change that. You know the 3 traps, and you have the survival protocol to navigate them. Thank you for your time and attention today. If this lesson resonated with you, please show your support by giving this video a like. Share it with a trading partner who needs to hear this message. And if you haven't already, hit that subscribe button and turn on the notification bell so you don't miss our next deep dive. We have a lot more to cover on this journey to trading mastery, and I want to make sure you're here for it. This is Forex Academy. Trade safe and trade disciplined.